Now, geopolitical tensions between Russia, Ukraine, Europe, fluctuating oil prices, increasing dollar, all this is also keeping markets on tenterhooks. As a result, many uncertain events take place during these times, or as our guest calls it, aberrations or financial surprises. What are these situations and how should you deal with them? To help us understand all of this, we have on board Santosh Navlani, CEO, ET Money. Santosh, good evening. Welcome to the show. So we'll be talking about surprises in the year so far. Are these positive surprises, or we are talking about a mix of positive and negative surprises?
Hi, Kavita. I think it depends on how your position, how your portfolio is positioned, is how you would perceive these as positive and negative surprises. I think more than positive and negative surprises is actually about lessons we can keep learning and relearning, which we tend to forget in good times. And I think right from March 2020, end of the month, till good part of 2021, it was a one-way rally in the markets, and not just in markets, but across asset classes where people made a lot of money. I think these kind of events which happen and a year becomes a kind of year full of aberrations is actually a good time to revisit investment fundamentals and how sometimes traditional wisdom of investment may not hold true is what these kind of years teach us, is how I put it.
Talking about surprises, are these surprises a new form of surprise you're talking about? Because talking about benchmark times in markets, 2008 and even now, how different are these surprises? And I can see you have a set of at least 5 to 6 surprises that financial investors should understand and, apply these surprises in their portfolio as per their strategies accordingly. So what are we talking about if I want to ask you the first surprise?
Yeah, so Kavita, before we come to the first surprise, what is important to understand is, ultimately, financial markets or economy, they actually give rise to some kind of extremes in every market scenario. The extremes can be pessimism, extremes can be optimism or irrational exuberance, how they manifest in terms of returns and risk equation on different asset classes varies each time. So reason can be different. Sometimes it can be global financial crisis. Sometimes it can be inflation. It can be exacerbated by the Russia-Ukraine war for the sake of it, or any other event which may just pull the world back to this original position. But all these things, it actually becomes an excuse to get the things where they belong to the fair prices, at least for that time period in that sense. So in 2008, what we saw was a rise of a gold rally in that sense, a beginning of gold rally in 2008, and it went on for 4 years. In fact, in 2008 till 2011, each of these 4 calendar years actually returned upwards of 20% on gold. In fact, 2011 had 30% return on gold. So gold fanatics had a great time. And in these same times, because world was so much in risk-off mode, State Bank of India was actually offering almost 10.5% fixed deposit on a 3-year FD, and government-backed PSUs were offering tax-free bonds of region of 8.5% interest rate. So what happens is something which was actually not doing or not being available to a lot of people suddenly start becoming available. You start questioning whether it is worth giving this kind of interest rates or assured returns or not. But this is what world teaches us. And I think we are just basically looking at what is different this time in 2022. And the first one which we see is actually having kind of debt funds in the portfolio actually seem to work well. And the first one is the debt funds which are actually on lower duration side are earning better returns than short-term debt funds. So if I can kind of specify it further, a liquid fund or an overnight fund or a money market fund has given almost upwards of 3.5% return in this calendar year so far, then a high or larger duration fund like short-term fund, dynamic bond funds, or for that matter, like corporate bond for or even medium-term bond fund. So what is happening is the lower the duration or investment horizon you have, the better the outcome is becoming for you as an investor, which doesn't happen typically. The larger duration that you have, that's where you will get rewarded in life. So one thing is the aspect of time horizon is completely off in 2022, where the closer you are to cash, the better you are earning your returns on.
You mentioned debt funds. So, if I want to take this conversation towards the entire basket of fixed income instruments, and here I would want to talk about government bonds and government bonds and fixed deposit. Do you think that it's time for investors to now start looking at these investment instruments as well? What is the kind of surprise over here that we are talking about?
Yeah, so for the one thing which is quite surprising beyond short duration, or the lower the duration you have in a portfolio, the better it is that for the first time that at least we can look in things is the government of India bonds are actually yielding more than private sector bank FDs. Now, typically, you would trust the sovereign more and possibly be happy to settle with a lower interest rate than actually lending your money in the form of fixed deposit to private sector banks. For the first time, we are seeing that a T-bill, a one-year T-bill is earning better than one-year FD. The one-year T-bill return is upwards of 6% right now. If you look at a GSEC of 10-year, it is yielding almost 7.4, 7.5% depending on the data you look at, compared to a State Bank of India FD for upwards of 2 to 3 years yielding only about 6.4, 6.5%. In fact, most private sector banks are in the region of 6.1% today. So private sector banks and State Bank of India FDs are actually yielding less than Government of India bonds, which is quite a big surprise. I don't think these kind of things happen very often in the marketplace. So if this is the reality, then bank FDs is not accessible to you or not rewarding for you beyond after the taxation impact you incur. And Government of India bonds is not easy to buy for retail investor today. What happens is you should go and look for opportunities in non-banking financial companies, FDs, or those kind of instruments. And on eating money, actually, we have available Bajaj Finance FDs, which actually give you upwards of 7.4% for years of 4 to 5 years. And it becomes far more reliable way to grow your money than getting caught into low yielding debt instruments. Even HDFC Limited or a couple of other NBFCs are yielding pretty good yield right now compared to bank FDs and Government of India bonds. So I think it's more about discovering where the alpha lies when the returns from equity markets are uncertain today.
And which is why, as you rightly mentioned, it's a very nice time to look at corporate fixed deposits and how should one go about it. I think all the details one can get from the ET Money website. But then talking about liquid funds, if I want to compare this category with the rest of the investment instruments available in debt fund category, how have liquid funds fared, and is this the time to look at liquid funds? I mean, we usually recommend liquid funds or ultra short term, to build a corpus, to build a contingency fund and emergency corpus. But what about returns?
Yeah, so I don't think, Savita, we should change our investment plans drastically based on what is happening in the marketplace. We keep talking about focusing on asset allocation and having an emergency fund. Now, liquid funds returns are variable in nature. They will always be linked to, in some form or the other, with the repo rate and the prevailing short-term interest rates in the economy. So when the liquidity was abundant and the interest rates were towards the lower end of the side historically in 2021 and good part of 2020, liquid funds yielded up less than 2% or even 2.5%, very, very rarely for some kind of quarters or months in that sense. Right now, liquid funds are yielding more. So the proposition of liquid funds has remained same. It's a very good cash replacement for you, which has some amount of risk, but not if you stay invested for at least a few weeks or months. Very few occasions a liquid fund has not returned any kind of interest or return on that. So the proposition doesn't change just because markets have changed. We are thinking from perspective of what are surprising things happening in the marketplace today. So I would continue recommending the emergency funds. You should be actually considering having a liquid fund or overnight fund or money market fund kind of instrument for that, and of course have go towards short-term funds and medium-term funds or corporate bond funds for your long-term debt holdings. I think fundamentals don't change. It's about taking a pause, looking at the surprising data and learning from it how you should not get carried away with what the market narrative may be at some point of time to modify investments randomly.
Okay, talking about the year 2022 and so far the kind of diversified portfolio investors usually have and the kind of questions also we get, a lot of them have international exposure. Now that part of the portfolio has not been performing. So what's the surprise over here and how long do we think the surprise is going to keep shocking the investors diversify towards the international market?
Yeah, so if you look at how international funds have performed, it's not a bloodbath across the board. Of course, if you compare those returns with Indian markets, where Nifty has possibly not gone anywhere on a 1 year basis returns, or even YTD in that sense. Forget the rally for in the month of July, or recent rally in the month of October. The fact is, over 1 year, Nifty has not returned anything. So when you compare with Nifty, the international markets have been brutal. What basically stands out in this is Nasdaq, where Nasdaq has almost gone down by upwards of 32% in price terms, in US dollar terms, thanks to the rupee depreciation. The Nasdaq returns in rupee terms have possibly been minus 20% instead of minus 30%, because rupee depreciation has come into picture. But the fact is, people have been surprised that they actually invested in Nasdaq or Nasdaq oriented funds or tech oriented funds, given the bull run the stocks saw, or the certainty of earnings or strong business models that companies like Google, Facebook, Apple, or Microsoft for that matter had. All these stocks which people actually bought and also invested through Nasdaq, they've been largely down because of the interest rates starting to going up. So if you were a diversified investor in S&P 500 index fund, or for that matter a diversified international fund, your portfolio would not be as much red as it is. So the idea is, while international funds should be part of your portfolio, how to invest in international funds basically is a relearning happening in the marketplace today, given that most people invested in Nasdaq, whereas they should have been more diversified today. So that's a learning, in my opinion, that people should take and stay diversified. It is worth mentioning that Nasdaq, while it has given superlative returns over the last many years, the fact is Nasdaq is one of the index which actually is not given returns for over 15-year period, from March 2000 till July 2015, if I can correctly recollect properly. There is a 15-year period of no return in Nasdaq, and I think it's a reminder to people that they should not just carried away by having a thematic fund in their portfolio, especially international.
All right, Santosh, time is almost up, but then I really want to understand that equity returns, if you talk about, have been really flat. Now, gold has not been performing as it should be in the current scenario. Looking at all of this, what's a surprise on the portfolio front? And if you talk about rebalancing, what should be the action taken by the investors right now?
So, Kavita, at ET Money, we've always been, advisors who recommend to have a diversified portfolio of equity, debt, and gold in some form or other. In fact, we believe in more of dynamic asset allocation based investments than actually having static asset allocation. So there are two ways to do it. If I can recommend more of a general answer to this entire thing, having a 60-40 portfolio, 60 equity and 40 debt, possibly serves investor best as long as they keep rebalancing their portfolio at least once a year. But if you don't do that and you want to have a more dynamic approach to it, understand how gold behaves. Gold typically behaves in a nice way and starts giving good returns when there is a gloom and doom scenario in the marketplace. But 2022, except some period during February to April, the returns from gold have been very, very marginal, or practically nothing in this entire year. What is important to understand is gold has not performed because the safe haven this year is not gold, is dollar. Because of the increase in interest rates by Fed, dollar is becoming the safety currency of the world and not gold, and hence there is no return coming from gold. But doesn't mean that you should shun away the gold completely. It's about having diversified portfolio, having some kind of rule book, 5 to 10% allocation to gold, 20-30% allocation to debt, and rest being equity can see you good in long term. But when in the current scenario, interest rates in the country, the risk-free return on GSEC is 7.6, 7.5. It doesn't make sense to be a lopsided equity portfolio, even if market might tell us that there's a rally beginning in the marketplace today. So I would say stay diversified across asset classes is what the mantra should be for all the times, not just 2022.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.